Hey guys, real quick, I want to go over the 4 types of funding for your business opportunities in our financing options lesson. So, right off the bat, finance, the science of money management. Money does not grow on trees, therefore, we must know how to manage it. Even if it did grow on trees, we probably would still have to know how to manage it. The science of money management is very, very, very important. So, finance and business is goes together because when you run a business, you have to know how to manage the money for that business. If you don't know how to manage the money for that business, your business likely isn't going to be very successful. So when you talk about business finance, you're talking about capital investments, investments into the machinery or the building or the processes that make manufacture or make your business run more smoothly. You also talk about salaries and paying your employees a wage to work for you, purchasing and how you buy these items that you're turning into an item that you're going to sell, and other expenses like shipping cost and insurance costs and that kind of thing. So what you talk about when you finance a business is you're talking about kind of managing all of this, and it can rack up pretty quickly depending on what you're doing. It's important that you understand that there are 4 types of ways for your business to make it work. The first type is going to be retained earnings. The second type is going to be stock issue. The third type is going to be business loans. And the fourth type is a new type called crowdfunding. Retained earnings, I like to think of as a piggy bank. You hold a portion of revenue for a company in an account for operating in the future. It's taking a small part of your profits, putting it aside, and saving it for that later date, that rainy day, whatever you want to call it. So that's what a retained earnings is, and that's how it works. So when we talk about retained earnings, what we're really talking about is we're talking about this opportunity for this revenue to take place and this revenue to happen, and to hold that revenue for a future date. The pros of it is you keep the bank out of it and you're self-sufficient. You don't worry about other things. All you have to do is worry about making sure that you can run your business and save enough money to operate in the future. All right, so those are 2 pros. The cons, you must be profitable. If your company starts out and you're not turning a profit, you're just taking more away, and you're going to run out pretty quickly. Plus, you have a limited amount of money for those capital resources. You don't have as much money. You can't buy, you can't build as quickly as maybe another company might be. You want to avoid going out of business. So these items must happen. Maybe you need to build to keep up, and you'll have to take on some additional debt. But retained earnings is a good way to start. The next is a stock issue. A stock issue occurs when a business offers up small portions of ownership in the business to outside parties. Whether it's public or private stock issue, it doesn't matter, but stock issue is still there. Facebook companies like Facebook and Twitter recently just went through their initial public offering, which meant that they finally offered the stock back to the public and put it back on the stock exchanges. Pros of a stock issue are that you get lots of money very quickly. All right, Facebook and Twitter made a ton of money, which led to Facebook trying to buy Snapchat. And you see it as kind of continued source of income if you divide the stock, so that it's not just a one-time thing. You can say, well, all these stock issues, we're going to double the amount of stock. And if you have this many, you now have 2 shares and so forth, and you can kind of continue to do that. Some of the downsides of it is that you lose all ownership. No longer do you own every part of that business. Somebody else now has a part of that business. And then finally, the last one is that you have to pay out dividends. So the earnings that you're making, some of it goes back to the stockholders, which means that you're not getting quite as much as you probably could have. The next type is a business loan, and that involves going to a bank and seeking the bank's backing for the company. This is different than getting a line of credit from a bank. The business loan is basically you're taking a lump sum of money to run and to operate. And there's a pretty strict process, and you have to put up some collateral to get this loan. Pros of backing from a bank are that, you do have a bank behind you. You have a source of income there. You can continue to do that, and as you pay it off, you can continue to take out loans to run. Plus, you'll be given a line of credit, which will help you float things between. It'd be a good way to go about it. It's not a bad way to do it. It's just you have to kind of remember the con side of things too, is you're going to be making monthly payment, and you have collateral, bank control. So the bank can take over your business or take your home or do something if you take money out as a business loan. The last type is crowdfunding. Crowdfunding is kind of a new way of fundraising. Think of Girl Scouts knocking on your door. That's fundraising. They come, they knock, and they get you to do that. Think about the ALS Ice Bucket Challenge. That's also a fundraising activity. Crowdfunding is a little bit different because it's usually taking a large number of investors into something specific and not research or public radio or something like that. And you're typically doing it over the internet. So no longer are you going door to door to sell cookies, but you're making a 2-minute YouTube video that explains why this product's going to be successful and uploading it to a company like Kickstarter, who will assist you in getting people that message and collect the money for you. All right. Pros, you get engagement with your potential customers. So you start and they're investing into you right away. A lot of times on Kickstarter campaigns, you see some sort of rewards for donating or for funding this project. It might be something like dinner with, the executives, or, you get 2 free coolers for the coolest cooler. All right, you can kind of see that, and it's keeping banks out of it. So a lot of times with that strict process for banks is you have to worry about, are they going to approve me? Is this real? Crowdfunding takes that out of play. Crowdfunding allows you to do this with the non-bank options. The cons, donor exhaustion. As we see more and more donors out there, we see this donor exhaustion, and it's something that's continuously being studied, and they haven't quite formulated yet, but they do know that this is going to probably come into play as you continue. You see less and less people willing to support. Finally, your reputation. If you fail to meet your goal on this, your reputation's bad. It means that your product's probably not that good, and you could get very, very upset very quickly about it. So it's pretty important that you make sure that you have a good reputation and that you're doing this crowdfunding way in an appropriate way. And again, crowdfunding is the new fundraising. It's the same idea. All right, you're getting lots of investors, and instead of it going to a company, it's going to you. In closing, money doesn't grow on trees, and you must find a way to finance your business. And I've provided you with 4 options. First option was your retained earnings, a stock issue, all right, business loans, and finally the new crowdfunding. So for your assignment, you guys have to pick and choose which one you're going to do and how you're going to do it. All right, I wish you the best of luck, and I'll see you guys in class.